Hi, and welcome to our LinkedIn Live series on the release of the ISM Report on Business. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management. That's ISM's member publication. And we're excited to have you with us as we discuss a pivotal month for the Manufacturing PMI and the Report on Business. And not just because of the composite index was an expansion for the first time in since October 2022. We'll talk a little bit more about that later, but for right now, let's focus on the manufacturing PMI. It registered 50.9% in January to end a streak of 26 straight months in contraction. But much of that enthusiasm was tempered by the potential impact of tariffs on products from Canada and Mexico, announced over the weekend, though a 30-day delay on the duties on Mexican products was announced in the last hour, and we'll talk a little bit more about that. I'm sure it's going to be a fluctuating situation throughout the day and the week. But let's get to that and bring in Timothy R. Fiore. He's the chair of the ISM Manufacturing Business Survey Committee. Tim, you can talk about the data for the month, but I know we should lead off with what everybody is talking about, which is the potential impact of the tariffs. And as I said, that's a constantly fluctuating situation. But just talk about that. And I know you've got some PMI data that you can cite. You discussed it earlier today about the impact of the trade war in 2018 and how that impacted the ROB. But just go ahead with your overview of what we saw last month.
Okay, so let's make sure that we avoid the shiny object. The shiny object here is tariffs. That came about on Friday night and went away on Monday morning. So let's not, at least with Mexico and probably Canada too. We'll spend some time at the end of the conversation about that. This was a really good performance month in January. And we're not losing sight, but it's not getting the traction it really deserves if you're into an orderly grow out of the economy. Or if you're into chaos and news, okay, boring. But if you're into what's really going on, this is an excellent report. So we had demand coming back for the third straight month, stronger than the prior 2 months. We saw signs in November of demand coming back. December was a confirmation, but it was still a little tenuous. January is a confirmation. The good thing here too is, and many of you who watch this stuff, you've heard about the issues around the survey issues now and seasonal factors. Seasonal factors have been a big issue with jobs, and it's primarily focused around Q1 activity. But so I'm going to talk about our seasonal factors, which we've done before. We've talked about it before. Our seasonal factors this month were half of what they were 12 months ago. So, if the seasonal factor added 4 points 12 months ago to a new orders number, it added 2 this month. So we not only had weaker seasonals this month, we had stronger base performance. So the two of those together is like, this is a really good report. This is real stuff. I'm a seasonal believer, and the seasonals were half for a reason, and we still did better than we did a year ago, and we've done better than the last 24 months. So new orders are up. New export orders supported that. There was comments in the panelists about China having a bit of activity. A lot of it was around stimulus, but my guess is it's the combination of both stimulus as well as buy-aheads, because they were, the Chinese companies were getting ready for counter tariffs, so they tried to get as much U.S. product as they could beforehand. The buyers over there are the same issue that we do here when it comes to tariffs. If you got a counter tariff, nobody wants it, but that's just the way it was going to be. So demand is coming back. It wasn't strong enough to build the backlog. We're still shrinking backlog at moderate levels, but I'm not that worried about that. That's going to come back in the next couple of months. We broke, as you said, Dan, we broke 50 for the first time in many months. I had been predicting, if you go back 3 or 4 months, I probably was saying February or March for the PMI breaking 50. I think last month it was primarily February. Well, we beat it a month early, and we beat it in a high quality level. In other words, there was no unusual thing that drove it, like something that would drive the supplier delivery number up, or a whole bunch of manufacturing inventory being captured. So we did it from pure good quality growth. Now let's look at the output side. The output side at 52.5 on the production number, good surrogate for revenue. That means we grew our output in January compared to month by probably 3 to 4%, somewhere near 5%. That's positive. That's positive. And again, the seasonal factor wasn't as strong on the production number this month as it was a year ago. So all good. The employment number, we dropped to a 1-to-1 hire to fire ratio. That 1-to-1 is the best number that we've had in about 6 months, since May, I think. The worst number, I think, was 1-to-3 was our worst number. So we're slowing down the layoffs. Layoffs were the number one tool used, even more so than attriting down. So, but I think we're at the end of that. I think we've stabilized our business plan. It's conservative. We've destaffed our headcount to meet that business plan. We're ready for growth. And, we're not really thinking we're going to grow dramatically probably till the end of the first half. So the other thing I want to pass on before I leave demand is we had a 2-to-1 demand sentiment. That's the best number that we've had inside of 9 months anyway, since we had a false start probably back in February of last year. 2-to-1. We've been running negative. The demand sentiment have been 1-to-2, 1-to-3. So all the things are aligned well on demand. Everything is aligned good in the factory. And on the input side, it's pretty much it's accommodative. The only issue on the input side was really the prices number being up so high. So I spent a lot of time on the phone. Well, didn't spend a lot of time on it because tariffs have kind of overwhelmed everything. But the cool news in this report is the prices number at 54 and some change in a not a really strong demand environment. Why is that? What's going on? There's not a global conflict on this. There's no Suez Canal thing. What is this? Well, it could be a couple of things. I'm going to theorize that we said in our forecast in December that we were going to see a 3% growth in our input costs in 2025, and we would see it in the first 6 months of 25. Well, I think we're seeing it. I think we saw some of that in December. We talked a bit about that. Should it really have been in December, or people just reporting that they know they're going to be paying higher prices, and they reported in December? Well, January kind of confirms that we are paying higher prices in January compared to what we were paying at the end of last year. I think that's kind of clear. If that's the case, then you will see that number ease in February and March. You're not going to see another 55 because they've already put the prices in place. So, I'm not saying you're going to see a negative number. You could see a 52, 53, but this 55 was kind of alarming. And of everything in the report, that's the thing that has got me the most concerned, I think.
Yeah, let's camp right there because I did have a question about that. You, in the report itself, you did quote something to the effect that pressure on prices will be a challenge, for companies in 2025. You please elaborate that on that a little bit.
Yeah, so we already have price pressure in January with relatively weak demand. It's not super strong demand. If it was strong demand, you see that supplier delivery number a lot stiffer. Remember, we're waiting for that supplier delivery number to stiffen up. And then we know all the demand is filtered down at the lowest level and is causing suppliers to struggle. So if you already have price growth and you don't have strong demand, there's only one place that price can go over time. As demand increases, that price growth is going to increase. So what do we do about that? What can you cut rates? Why would you cut rates if you got prices growing? And, in an environment where, okay, we're expanding, but we're not expanding super strong. The other thing that I've said is that absent of any kind of fiscal stimulus, there's no reason for this grow out to be that dramatic. And I still feel that way. There's no reason for 2025 to be a strong growth year. And I don't see anything on the horizon either. I do see the tariff issue as being a pretty strong headwind that could turn us into a contraction again by the time we hit June. And then, what happens? Do we see rate cuts then? I mean, I think that's a plausible argument. But, we also talked about, are Trump's tariffs real or are they a feint? And I've been saying yes and yes. And I think we saw the demonstration of that today. It was a statement. They had to get the statement out. It was only out there for the weekend. So we didn't have 3 trading days to struggle over this. I think we had 30 minutes of trading struggling before it got withdrawn. Yeah. So, you got to, hold on to your seats, hold on to your hat. This is what life is like. Business does not like uncertainty. We don't react well to that. And we just saw a great example of that. And so do I think that we're going to resolve this thing with Mexico? And I think Canada tonight, although apparently the two don't like each other, I think they will get to an agreement to suspend 30 days. So the 3 of us can meet over the next 30 days and come up with whatever. I mean, who knows what we really want? I don't. We obviously want help on the border in Mexico, no doubt. They're already helping us with that. What else do we want? There's more that we want more. So, and I think that will get resolved, because it's not in anybody's interest to take a North American market for electronics, for transportation equipment, agriculture. I heard this morning that the potash, all of our potash we use in the U.S. comes from Canada. I think that's true. Canada's the #1 potash producer. All of a sudden, our fertilizer prices go up. How's that helping anybody?
Yeah,
I think they'll work it all out over the month. So we're going to end up back with the U.S., China. Now, we could have a European tariff thrown in there in the meantime. Most likely we will, because it's a demonstration that I can do it. I will do it, and that's what we saw here with Mexico. But I think I don't know if I mentioned it on this call, and we can talk more about the tariffs. What was a kind of a big indicator for me was they specifically excluded drawbacks. Now, drawback is duty drawback. So if the U.S. manufactured 50% of the value of that car coming in from Canada, they're going to tariff 100% of the value of that car, including 50% U.S. content. What normally happens then is you apply in the background to recover 50% of that, because 50% of it is U.S. content. They specifically excluded that in the executive order, which I don't think is reasonable. It probably wouldn't even withstand itself in court. So it was like, okay, what are you doing here? Well, you're just telling everybody that you look at the top level. Don't worry about drawback. You're not going to get drawback. It was just another statement that, hey, this is real, and we're going to do it because we can do it.
Yeah. Yeah, you and I have talked, about the tariff dynamic. Well, since the whole thing, became a dynamic in 2017, and we spoke just recently for a story in the January-February issue of Inside Supply Management, how basically the gist of it was our tariffs pretty much the new normal. I guess, yeah, we've had this drama, and it looks like it's going to be resolved, and with Canada and Mexico at least. But as you mentioned, or have mentioned often, China is still going to be a dynamic. I guess as we put the tariffs issue to bed for this call at least, do you expect more of the same? Just the same environment that manufacturers and companies have been contending with, pretty much since 2017, and they've navigated it.
With respect to China, you mean?
Yeah, well, and overall, just the tariff environment overall.
Well, that's a huge question, but let's talk about China first.
Yeah,
we've had tariffs in place with China since 2018, so we're just now increasing the tariff. So I don't see a huge disruption in the supply chain. I don't see a lot of blockage at ports. I just see the money that we have to pay to get Chinese product is going to be higher. Okay. Currency will offset some of that, probably. The yuan will probably weaken, dollar gets stronger, and therefore that 15%, whatever it is, on a Chinese product will turn out to be something different. There's been a whole lot of activity done in the last 6 years for China to insulate itself from additional tariffs. Not only was Vietnam becoming, I think, our number 5 importer now, when they were probably number 50, it's 8 years ago. So China's established a base in Vietnam. You can see it in Thailand. There's other countries in Southeast Asia that are benefiting from this. There's no doubt in my mind that product is still flowing from China to those countries. How they're able to do that and avoid the HTC codes, I don't understand, but I'm sure it's happening. And you also have Chinese companies coming into Mexico and setting up shop, and they're probably buying a bunch of stuff from China to support those shops. So it's all China's effort to try to avoid this tariff regime. And what is the real issue? The real issue is we're having trouble agreeing with China on a lot of things. And when we really sit down and get into those discussions, if we ever do, then we're making progress. In the meantime, this is tactical. It's painful. Supply chain people do not like artificial barriers to free trade. We are free traders at heart. And this is just artificial barriers that make our job more difficult.
Yeah. Well, it's one more thing, kind of correlated, hasn't been talked about in the coverage that I've seen today, but the inventories index really interested me. it actually went down a couple of points. And I think a lot of people might have expected that to go up just in preparation for tariffs. And you had a quote in the report itself about, some of the supply and demand, factors that are impacting that I thought was interesting. Could you just touch on that particular index a little bit?
Yeah, in the month of December, we saw the manufacturing inventory number get up to its higher level. It was under 50, but I think it was 48 change. Let's see, it was 48.4. The month before that, 47.7. And all of a sudden, we're down to 45.9. A little bit of a surprise, but we always have some trouble at the following month after we close a quarter because inventory is really hard to measure. And it's a one-time event. You measured at at midnight on the 31st of the month. Really hard for supply managers to understand what really happened to inventory until 4 or 5 days into the following month. So you may end up having a combination. This is end of year and January inventory in some respects. Could very well be. We've had this issue before. So I think it's an unusually low number in a growth environment, unless that happened and or our production rates were much more than what we thought at the beginning of the month. Therefore, we consume more manufacturing inventory than we had planned in January. That could very well be. So I think, watch February. And I think the February number, without that supplier delivery number being at 55, 56, there's no reason that inventory number should stay low when you have a decent amount of demand.
Yeah.
So February should see that number come back to 48. But the big thing that I would be watching for going forward is that supplier delivery number stiffening up like a rope and hitting that 55, hitting 56. That means all the demand from all the industries is aggregating itself down to the lowest levels. And that's then putting pressure on lead times and putting pressure on supplier execution, which then turns into late deliveries and pressure on transportation fleets to move product faster. And then you have price growth in transportation, and you have less assets available. On we go into the next expansion cycle.
Yeah. Well, employment is always going to be a dynamic that's going to get attention in the report on business, and it contracted. The index contracted for 14 of the previous 16 months, but it was an expansion in January. I know you've been talking about workforce reductions and right sizing in the past few months. Do you think those efforts have pretty much reached their fruition now, and companies have the levels that they feel they need going forward?
Yeah, I think we're there. Remove any external factors like counter tariffs and things. Okay, we'll just put those aside. I think we're absolutely there. I think we worked our way through it. I think that we're in a good position. So there's no reason why this thing shouldn't continue to grow. But like I've said, it's not going to be a really strong growth. There's no reason for it to be a strong growth. Right now, there's nothing that is accommodative. You got restrictive rates. You've got the end of tax cuts happening at the end of the year. You have no external factor that's driving us to invest in anything. The only thing that's growing here is we're coming off of over 2 years of contraction where we've been holding back on capital investments and other investments because of the uncertainty about the future. So I think, we have a new administration that provided some certainty. We know that they're business friendly. They want to reduce the amount of regulations. They want to be business friendly. But what does that really mean? They're probably going to be deficit reduction. I mean, they're probably going to be deficit continuation. So we're not cutting our deficit. So, we're going to have to see where this thing, works itself out.
Yeah. Well, is there any other dynamic that, we haven't discussed, or anything that you feel is important to include? And I ask that in the lens of, we have had one-off expansions in the past in the manufacturing PMI and the services PMI. And I know you've talked about some of the dynamics that, give you confidence that this growth will be a little bit more lasting. Just elaborate on that a little bit.
Well, you had sentiment being the best sentiment we've had in a year. You got new export orders finally showing some life. We broke 55 on the new order level. We've done the best on our demand numbers in a year, even though our seasonal factors on the new order number was half of what it was last year. So, like I've said many times over the last 8 years, without demand, you've got nothing. And we went 2 years with no demand. So we burned up the order books. So we're now seeing demand starting to come back. Just so happens at the beginning of a calendar year, just so happens it's at the beginning of a new administration that is clearly business friendly. So, I think the issue now will be somehow dealing with these extraneous issues where we're using economic means to get other concessions from our trading partners. I mean, I'm not quite sure what fentanyl and illegal immigration has to do with what Mexico ships to the U.S. So in past lives, that would never even have been allowed. But here we are using all the levers of government to satisfy the current administration's desire to resolve other issues. I'm not saying that's a bad thing. We just have never really done that. And we've watched China do that for years. Many, many times. There's so many examples of it. And I think probably the Republicans are jealous of that to some extent. And I don't blame them. There are limits. Like this duty drawback thing makes no sense at all. But, okay, use all the resources to benefit America without degrading our position in the world. That stands to reason. But, we're at a different time now. It's a different shift. We'll see where the Trump administration brings us. It's a very, I grew up in, expanding, global trade, the world order, share the wealth with countries, avoid wars because of it. And now we're, rattling sabers and doing threats to benefit just America. Well, the last 70 years of economic expansion have benefited America. So we're in a new environment. I don't know what's right or wrong, but I know it's different and everybody's going to react different. And it's really hard to predict. So this is the most difficult time I've had in my 96 some odd report outs, giving you my opinion about next month or the month after. But actually, if you had asked me at 8:30, 9 o'clock this morning, I would be really confused. You're asking me now, I don't think Mexico and Canada are going to be issues. So that provides a lot of clarity. I think we're gonna whack Europe, because we can, and we're going to get into some pretty deep conversations with China. I think that's clear, and that will be a lot less impactful to the U.S. economy than trade wars with Canada and Mexico.